As an options trader, wouldn't you agree it's important to understand the risk that you're taking on? Well, I have a question for you. Which option strategy would you say is more dangerous? The naked put option strategy or the 112 options strategy? And why? Well, today we're going to take a close look at these two strategies side by side to unveil hidden facts as to just how dangerous they really are. Be prepared to be shocked. Let's dive in.
SJ Options changing lives. We're here to teach the real ways. Make the right plays. I'm your mentor. Trust me, we can start today.
In today's video, we're going to construct a naked put and a 112 strategy. Both start with a similar amount of credit. The only significant difference of the two trades will be the extra pot of gold, which the 112 could possibly realize at expiration.
Options elevated.
Before we delve into the specifics, a naked put, also known as an uncovered put, is a type of options trade where the seller writes a put option without holding the underlying asset or any other offsetting position. Without any hedge for the puts that are sold, this trade has essentially unlimited risk. Take a look at this risk profile. Here we see that this type of trade can profit over a bullish move, a neutral move, and even a slightly bearish move. However, as the underlying falls, this trade continues to lose money pretty much forever.
Every entry calculated, precise indeed. SJ Options fulfilling the need.
The naked put creates a short vega, a short vama, and a long vana position. All three of these Greeks related to volatility will cause losses to the naked put as volatility rises.
Risk averse is worth the price. Options trading, we got the slice. SJ Options changing lives.
Now, let's talk about the 112 strategy. And this strategy involves a combination of option positions, buying one put option near the 25 delta, selling one lower strike put option, and selling two more out of the money put options. Essentially, you have a 3-to-1 front ratio spread comprised of puts. The goal of the 112 is very similar to that of the naked put. However, this structure gives you a small probability for a large profit if the underlying moves down slowly just before it expires.
With SJ Options, the stars are confined.
Similar to the naked put, the 112 strategy also comprises short vega, short vama, and long vana, all which are dangerous to the trade during a rise in volatility which occurs over a market crash. However, by creating a 3-to-1 ratio of short puts to long puts, the 112's Greeks are on steroids.
Vision in every trade we hold tight. Risk averse, we rise day and night.
To understand and to compare the risk of these two strategies, we're going to build each and simulate a trade over the COVID crash. First, let's take a look at the naked put simulation. And remember, this trade starts with the chance to make the same profit as the 112, with the exception of that little pot of gold at expiration. During a market crash, the naked put seller faces unlimited risk, which snowballs because of the vega, vama, and vana Greek structures. For instance, from February 19th, 2020 to March 23rd, 2020, SPX fell roughly 35%, and the naked put lost $286,000 and required an additional margin of $62,000 to stay in the trade. As we can see, a naked put trade that had a goal to make $9,000 quickly turned into a $286,000 loss. This one loss wiped out 3 years of returns. Now let's take a look at the 112 strategy over the same market crash.
With SJ options, we aim high. In the world of trading, we touch the sky.
The 112 strategy, similar to the naked put, aims to make about $9,000, but it also has a chance to profit roughly $50,000 with a small move to the downside during the last week of the trade. Take a good look at the beginning risk profile on February 19th, 2020. Now, let's fast forward to March 23rd when the market hit the bottom of the market crash. In contrast to the naked put, the 112 strategy loses $1.3 million during the same period of time. And the 112 also requires over $400,000 to stay in the trade, requiring a total of $1.7 million for this trade. This one loss wipes out over 12 years of perfect returns. The $1.7 million required compared to the mere $340,000 requirement of the naked put is rather eye-opening, don't you think? So although these trades appear to have a similar day step line, the risk of the two trades is totally different. Shockingly, the 112 loses 5 times the amount of the naked put, and it's clearly far more dangerous.
Analyzing, crafting strategies, we proceed.
So this begs the question, how can the 112 possibly lose so much more than the naked put? Well, let me explain it this way. When you add the debit spread to create probability, a small probability of this trade to make the $50,000 on the trade, well, then you finance this debit spread with additional naked puts, which increase the unlimited risk. By adding additional out-of-the-money naked puts to the tail of the option chain, you're increasing the danger of the trade because the debit spread in no way offers any protection for these fat tail naked puts in the face of a sharp increase of volatility. So although it appears to be a clever idea to add the debit spread, it's really making a naked put strategy far more dangerous. So who would have thought that the 112 is 5 times as dangerous as a similar naked put? This is why it's so important to understand options before you get involved. Because if you don't understand the risk, then that can lead to an unfortunate situation for your portfolio, yourself, and your family. It's also noteworthy that there's a number of traders on YouTube who advertise the 112 option strategy without explaining any of this risk involved, none of the risk which I've discussed with you today. Now, if you were to trade the debit spread alone, then you might consider it to be a bearish strategy. But when you combine it with the naked put for financing, you actually end up with something very dangerous. Because what you end up with is really just a leveraged naked put strategy. Hi there and welcome to my hike. I wanted to interject something while I'm in this beautiful place. And again, the reason is because there's so many traders online that really talk about the 112 and they mislead you because they make you believe that the 112 is actually a safer trade than a regular naked put. And everybody knows the naked put's extremely dangerous. So again, if there's one thing I want to emphasize and make sure that you take away from this video is that when you add the debit spread, you're adding additional naked puts to the trade to finance the debit spread, and that makes this trade far more dangerous. Enjoy the rest of the video.
Risk is managed, strategies aligned. With SJ options, success will find.
Some traders argue that you can simply put on a stop loss and not experience significant drawdowns. However, there's plenty of contradicting scenarios that this is not the case. For instance, many traders would move the stop loss down in order to avoid closing out the trade with a huge loss. Other traders might experience significant drawdowns by using a market order just to execute the stop loss. And then a limit order might never get executed, in which case a stop loss order would not even help. Then there could also be a gap in price, in which case the stop loss also will not work. Another situation might call for you to close out the trade only to initiate a new trade in hopes of capturing a rebound, but then if the market continues down, you just face subsequent losses.
Trading floors where dreams reside. SJ Options, your future guide.
When deciding between these strategies, there's really just one thing to consider. If the underlying falls just a few percent during the last few days of the trade, then the 112 offers a substantially higher profit potential. However, the naked put is by far a safer trade. So if you're looking for safety over a small chance to hit a grand slam, then the naked put would be the choice between these two option strategies presented here today. If you're willing to risk it all, including the farm, the 112 might be your best option. As a disclosure, I don't personally trade either one of these strategies. So how about you? Are you trading either of these strategies? Do you think the extra risk of the 112 is worth the possible reward? Please leave your feedback below. I'd like to hear your thoughts on these two strategies. And remember, every strategy has its pros and cons, and it's crucial to understand options on a deep level before diving into the stock market with your real money. If you found this video helpful today, don't forget to hit the like button, subscribe to our channel for more trading insights, and click the bell icon to stay updated with our latest videos. Thank you very much for watching, and best of luck with your options trading.
Got a method, it's precise. Risk averse is worth the price. Options trading, we got the slice. SJ Options, changing lives.